on the Monday edition of Money Life.
I actually do think there are two camps evolving, and one of them is saying you have not dealt with the inflation problem. If you cut rates, it's possible you could help reignite it to a higher level. And then there's the other camp that's saying, look, inflation will come down. It's just going to happen slowly. We need to deal with this labor market weakness. So I don't envy the policymakers at the Fed right now.
That's Amar Reganti, fixed income strategist for the Hartford Funds, talking about the two sides of the coin that the Federal Reserve is flipping and how investors are caught in the middle. And he says their reactions to either side that this coin could land on are not too much given the consequences. But up first today, Rachel Perez on a survey for bestmoney.com, which showed that 2/3 of consumers say they lose more on their rewards credit cards than they're gaining due to the annual fees and their usage patterns. David Traynor, founder and president of New Constructs, is here. He'll take us to the danger zone, where he says a popular stock, despite recent success, is back in the way of trouble. And Martin LeClaire, chief investment officer at Barrack Yard Advisors, is here talking stocks in the market call.
It's time to play.
It certainly is time to play. This is Money Life for November the 24th. Thank you so much for being here. My name is Chuck Jaffe. I am your host, and we've got an hour of great financial talk for you today. We're going to keep the intro to a minimum because we're going to let some of the interview time run a little bit. And we should, because it's great financial talk. But I hope you had a great weekend. I certainly enjoyed myself. Gail and I had a little bit of downtime, which was very, very nice. I got to watch my beloved Michigan Wolverines win their game against Maryland, setting up the game this coming weekend against Ohio State. That is awesome. But of course, before we get to this weekend, we've got Thanksgiving coming. But no, we're not taking any time off other than the Thanksgiving Day holiday. We've got great things planned, man. Tomorrow's lineup as good as we're going to have all year. And here it is on a holiday week. And we've got good things. So I hope you will plan to join us. It'll be interesting to watch how the market reacts on a holiday week because things do tend to get, well, a little... They're relaxed. They're not like people are not doing things we actually would expect coming into Thanksgiving. You might think that the market will gain because things are getting relaxed and ramped up for the holiday shopping season. And the holiday shopping season, that's where things might get ugly depending on the numbers we're hearing and what have you. It will be very interesting to watch because we just had a very volatile week and the S&P 500 has been slumping in November. In a holiday week, you can have things where a lot of investors take time off. That tends to mean that liquidity and trading volumes tend to be soft, and that can amplify whatever happens just because you don't have that much of a move when it comes to consensus, but you can move things around with the market. Next week, we debut a new feature. It's called The Week That Is, and I'm doing this with Vijay Marolia from Regal Point Capital, who has been on the show before. He's been in the market call. And what the week that is literally this, that, and the other thing. That is what happened in the week that ended. This is what's happening in the week ahead and what you should look out for. And the other thing is whatever winds up being something that VJ thinks you can take away in the week. So it's going to be a new feature that we do to start every week. We're excited about it. It's one of a couple of changes we hope we'll be making as we move forward over the next few months, but some things that we want to try that we think are going to be really interesting. So this will also have some other stuff I'll tell you about going on as we move forward with it, where you'll hear a version on the show, but you might be able, if you really like it, to get a slightly longer version just by looking in another place. It won't be anything that's behind a paywall or anything else, but we've got that coming as well. So that's something that we're going to be working on the holiday week. Meanwhile, we hope you are ready to live the money life around having a great Thanksgiving. For us to get you towards that, we have to start today's show. We start with Rachel Perez, then it's Amar Reganti, David Traynor, and Martin LeClaire. It's a great day to live the money life. The talk will prove that to you right after this message.
Exchange is more than a finance conference. It's a community. Join us to gain insights and connections that last. Visit exchangeetf.com.
Now let's take a look at what the survey said. Yes, welcome to The Survey Said on Money Life. This is where we dig into surveys, studies, polls, any kind of research or data that's going to help us understand what people are doing for, with, and about their money. And today we are looking at a survey that was done for bestmoney.com that looked at credit cards and specifically things like credit card rewards. And 2 out of 3 consumers admitted that they lose more than they gain on credit cards that have annual fees. Yes, there are great credit card perks, but does that mean you're getting your money's worth if you're spending up for them? It is a common problem that affects a lot of folks. The research really interesting. And if you, like me, pay a fee to have a credit card so that you can get the right perks, well, you do want to feel that you're getting your money's worth. So this may be one you want to check out. We have a direct link in our show notes or on our guest page where you can look for Rachel Perez. She is spokeswoman for North Star Inbound, which did the research for Best Money. Rachel Perez, welcome to Money Life.
Thank you so much for having me, Chuck. Excited to be here.
This is a really interesting one for me because in my younger days, when maybe sometimes I would carry a balance a little bit more than I would have wanted to or what have you, I didn't do any of the rewards cards. I never would have paid to have a credit card. And you can still get by with that. But these days, it makes a lot of sense. And I know I work hard to make sure that I get my money's worth from my cards. But I'm stunned to find out that 2/3 of people don't think they're getting their money's worth. Where's the disconnect? What is it that they should be getting that they're not, or why do they think they're falling so short?
I just wanted to start off by saying that we surveyed 1,000 credit card holders, and 83% of those are paying fees of less than $250 annually, which is why I think that data is also so surprising, because for 62% to believe that they have, lost money on a credit card that has a less than $250 fee is pretty shocking. But I think a lot of the disconnect comes with people really wanting to earn more cash back than they had been. The number one reason that consumers have a credit card with an annual fee, according to our study, is to be able to actually earn cash back, even over perks like airline points or premium hotel bookings. So I think a lot of people are just dissatisfied with how much cash back potentially they're earning with their cards.
Is the fault there with the cards, as in, I just want to be able to get more, or is the fault with the user? And I raise this question because I had an interaction with one of our audience members. We had talked about cards and using them properly and trying to make sure you're getting the right rewards. And Tracy in Ocean Springs, Mississippi was telling me that he uses a label maker to put a little label on the back of his credit cards so that he can remember that this one is 3% for dining and that one is whatever percent for groceries or what have you. Is that part of the problem as well? Is that we want more cash back, but the cash back programs mean we maybe need to have more than one card, which again, we're paying for, so we don't love it? Or is it that we're just not paying attention to where we can get the best cash back?
I think potentially it could be that consumers are not looking into the kind of benefits programs of their cards as fully as they could be. A lot of these cards offer things, even if it's not cash back, things like statement credits. So, people can use them on airline fees, food delivery, entertainment, hotel bookings. A lot of these cards as well offer really wonderful cashback programs. And like you said in Tracy's example, each card has its own potential benefits. So I do think that it's a really good point for users to go online and really check the fullness of their benefits. But even if they don't necessarily want to pay as much of a fee, in our study, 68% of consumers pointed out that they would be okay with paying less money even if they got fewer benefits. So I think a lot of people are just trying to potentially cut down on how much they're spending on credit cards, both on the cards themselves as well as on the annual fees per card.
What percentage of these people are paying for a card, looking for perks, but are not paying off their balance each month? Because that is always a bad deal.
Yes, that is certainly always a bad deal. We did not actually find out that particular piece of information. The one piece of information that I will say that stood out in that regard is that 46% of our younger cardholders, meaning our Gen Z cardholders under the age of 30, say that the pursuit of rewards has actually caused them to spend more than they otherwise would have. So we definitely do have data that shows that people are spending even more potentially on cards just to get those sorts of rewards.
There's also something in this study that talks about how people are hanging on to cards so that they don't let their points expire. But that becomes a game of diminishing returns. You're paying another annual fee. You're not necessarily using the card the way you should, et cetera. That's got to be one of those ones that find another way to use your points, turn them into a gift card or something, because most programs now have a way that you can redeem stuff more easily, even if it's not huge values.
Yes, absolutely. I mean, a lot of programs have things like statement credits. As I previously mentioned, in our study, we found out that 43% of people are using statement credits to compensate for airline fees. 36% are using them to compensate for things like food delivery, which is super duper common. So, definitely for those who are potentially keeping the cards open, maybe looking into things like statement credits can help them redeem as many points as possible prior to them potentially either wanting to choose another card or close their credit cards altogether.
Are folks who have these cards reluctant to sort of play the games that can come where, hey, I've got a card. Now the best deal, however, wouldn't be to stay with this card. It would be to go to the next one that has a welcome bonus or that has a different cash back thing that they're doing higher, et cetera. I mean, because they're losing ground rather than gaining on the annual fees, are they reluctant to change their habits at all or go after the next thing to make it that it really does work in their favor?
There is a little bit of reluctance as it pertains to kind of card hopping, if you will. We did find out, when we were asking about the most likely causes of canceling a card or changing a card, 27% of people actually ended up having called to cancel their card, but they ended up keeping it because of a retention offer. And only 10% of people were actually willing to move on to another card potentially because their competitor was offering a better sign up bonus. So there is a little bit of a kind of stay put for a lot of people with cards at the moment, or either a look to kind of get rid of cards, or the biggest reason why they would cancel a card is because there's an annual increase of $100 or more.
That would probably do it for me too. I think
Yeah.
that would make my relationship with a card issuer come to an end. And speaking of coming to an end, we've come to the end of our time. But Rachel, I really appreciate your help and your time. Thanks for joining me on Money Life.
Thank you so much for having me. Have a great day, Chuck.
That's Rachel Perez. She works for North Star Inbound, and they did the research on this survey for bestmoney.com. You can go there directly, or you can find the link in our show notes if you want to get to the study we've been talking about. We'll be back with more of Money Life right after this message.
VettaFi is the partner asset managers rely on across the entire product lifecycle. Learn how you can build and support the product of your dreams at VettaFi.com.
Welcome to the big interview on the November 24th edition of Money Life. Returning to the show today, Amar Reganti. He's fixed income strategist at the Hartford Funds. And by the way, he's also a former deputy director of the Office of Debt Management for the U.S. Treasury Department. And I tell you that because, yes, we're going to be talking about Fed and rates and things along those lines. But if in the process of that you want to learn more about Amar or the Hartford Funds, go to hartfordfunds.com. Amar Reganti, it's great to have you back with me on Money Life.
Thanks for having me, Chuck.
Let's start with the Fed, which, the market has been wavering on what the Fed's going to do next. I think the Fed has been wavering on what the Fed's going to do next. And of course, there's big questions about just how good the data is. So which is the overreaction here? Like, is the overreaction to the idea that the Fed might cut, or the overreaction to the idea that the Fed might not cut? And is what matters the overreaction or underreaction, or is what matters the actual cut?
I think what matters, and kind of working my way backwards through this, I think what matters is the actual cut and the communications around that cut, because it's one cut if it happens, but really we want to see what the groundwork is for 2026 on whether there'll be additional cuts that will take place. I don't think the market is underreacting or overreacting one way or the other here, because there's actually two well-entrenched sides of this debate. On one hand, you have a US economy where inflation is pernicious still. The Federal Reserve has not been able to get inflation down to its 2% target in nearly 5 years, so like a half a decade. So we're beyond what you'd call the short and intermediate term, and it's going to call into question the credibility of the institution for its inflation mandate. But the Fed has a second mandate too, and that's the one of full employment. And we know the labor market is getting weaker. We see this. Companies simply aren't hiring in the way that you would sort of expect in a good expansion. And secondly, there's some sectors that have been inordinately sort of hurt more than others. And I stumble over that word. And that's things like manufacturing and so on. So the Fed's paying attention also to this sort of tepid labor market. And then there's this uncertainty part, Chuck, which is that we used to have a pretty good sense of how many jobs you needed to create each month in order to make sure the unemployment rate didn't move up. Now, with the changes to immigration and the net supply of workers are available, that number has become less certain. So, one of the normal calibrating statistics in the labor market, which is the job growth portion, you have less certainty on exactly how much you need to make sure that the labor market is growing and healthy. So, the uncertainty is real, I guess, is the encapsulation of that.
As somebody who focuses on fixed income, although we may or may not get the rate cut, but at some point there will be the next cut in this cycle. It may take a little longer to get there. I don't think anybody's ruling it out or suggesting that rates are going to turn and change directions. So as an investor, is that all just short-term noise? Like as long as things move in the right direction and I'm planned out, do I really have to care what's happening day to day?
No, and what I mean by no is it's not short-term noise. And the reason is in prior cutting cycles, I think there was far more consensus about the direction of rates. Maybe there might have been debate about the speed of those rate cuts. This time, there's an actual debate on whether or not the interest rate policy or what's considered the neutral rate, which is the equilibrium rate for the US economy, whether we've reached that or not. That's really important because if inflation is not back down to 2% and the Federal Reserve engages in continued cuts, and that re-stimulates parts of the economy, you could actually see a scenario where inflation is driven even higher. And if that's the case, that has real implications for the level of bond yields and the shape of the curve. So I would say in normal times, Chuck, I would say, yeah, you know what? Like a lot of this is what I would call inside baseball among bond people, kind of debating, is it 2 cuts? Is it 3 cuts? Is it December? Is it later? But there would be a broad agreement that the cuts are going to happen. It's really the timing and sequence of it. This time, I actually do think there are two camps evolving. And one of them is saying, you have not dealt with the inflation problem. And if you cut rates, it's possible you could help reignite it to a higher level. And then there's the other camp that's saying, look, inflation will come down. It's just going to happen slowly. We need to deal with this labor market weakness. So I don't envy the policymakers at the Fed right now.
One of the stories that's not being told, and I'm curious for your take on it, and you may not have a take on it, but one of the stories that's not really being told a lot right now is what we're seeing with rates when it comes to Japan. On Thursday, the 20th, Japan's 30-year bond yield topped 3.4%. And I know some folks who say, look, this is terrifying because Japan owes 230% of everything that it makes. It's the most indebted nation in human history. And Japan is on the brink of some sort of a debt collapse because they artificially kept rates low. Talk about being between a rock and a hard place. They're still there. But Japan has a ton of our debt. And if they fall, there are other dominoes that will fall. How worried are you about the global financial picture right now? And that we could go from having had, very little defaults on pretty much any kind of paper for a long time to, things could get ugly here pretty quickly, regardless of what the Fed does.
I don't consider the dynamics in Japan one that's what I would call like broad-based risk for global markets. And let me kind of talk about why that's the case. There's a lot of things that are sort of what I would call special to Japan in this situation. Japan, went through decades of a deflationary environment, right? Meaning they could not get growth and inflation headed in the right direction. And when I mean inflation, they actually wanted some positive inflation, right? They needed inflation and wanted it to be above zero. And for a significant portion of time, it was either at zero or negative, in fact, which is very unhealthy for a large open economy. The second thing was, and is because Japanese policy, what I'd call almost regular policy mechanisms, weren't getting the economy back to a better place. It was really, Prime Minister Abe who did this sort of, you'd almost call it like a radical policy move called Abenomics. And it was threefold. Like one was for easy monetary policy, so rates to stay at or near zero. The second was for the government to be aggressive in its spending. And the third was for corporate reform to take place within Japan, ideally hoping that would spark productivity and growth. And they certainly leaned hard into this. As Japan is now experiencing some inflation, one of the things the Bank of Japan is slowly unwinding is its yield curve control program, meaning it capped government bond yields. And how did it do so? It could do it in two ways. It could either buy government bonds outright in the market, which it did. And at one point, the Bank of Japan owned about half of the outstanding government bond market. They owned it, full stop. And then second is they also signaled to the bond market that if anyone attempted to sell a bond cheaper, meaning the yield is higher and the price is lower, they would buy it at a certain price. So that kept interest rates relatively normal and level. Now Japan is going through a process where it recognizes it has some type of inflationary impact that's going on in its broader economy. Some of this was started during and after COVID, and Japan's an island, as you know, so it can be vulnerable to imports that are coming in. And the Bank of Japan has attempted to go about the process of beginning the process of allowing interest rates to rise. But they're being very careful about this, and they're attempting to do so in a way that doesn't accidentally put them back into a recession with deflation, because much like, the Peanuts cartoon where the football is yanked away, Japanese policymakers in the past have said, well, we're through the eye of the storm. We can begin the process of letting monetary policy tighten, and the ball got ripped away. So I think what they're going through is very specific to them. I don't think it has a threat to, global financial stability. They're a country with a high savings rate. So this is not, an issue that I would think is some kind of ripple effect. It's just you're starting to see numbers that you haven't seen there in a long time, and that's understandable. Sorry, that was a long explanation.
No, I'm good with the long explanation because I think we have not discussed much of this, so my audience is hearing some of it for the first time. So I very much appreciate the background. I do want to bring it back to what we are seeing domestically,
Sure.
because here we were talking about what was happening with the Fed and the easing cycle. I'm just curious how concerned you are about the quality of the data.
There's certainly some gaps in the data that came about from the government shutdown, and that was problematic. And certainly, I think the Fed would feel better if it had additional data. There is some private sector data that's available that, for at least a few months, you can utilize to kind of get a broader picture of things like employment and so on. So it's not great when you get to this point in the cycle. You don't want to take away any type of instruments that you can utilize. And I think the Fed would have liked it if the Bureau of Labor Statistics and the rest of the government had stayed open to continue to publish those. But I don't think it's a threat to their ability to make decisions right now. It may make them a little bit more cautious. It may make them say, let's wait and see when we have a little bit additional full data that hasn't, come about during the shutdown.
As we get into this rate cycle, we're also, of course, getting ready to turn the page on the calendar for the year. Your outlook for fixed income in terms of what are the areas you expect to be shining as we get into a rate cut environment or more of a rate cut environment next year? What are the areas that you're a little more circumspect on?
It's funny. There's the data and then there's how things feel. And I think you have to take both of those actually quite seriously. So the data says the US economy is in generally good shape. And what do I mean by good shape? You went through one of the fastest rate hiking cycles, mind you, a few years ago in modern history. And at one point, like 100 out of 100 economists said we'd be in a recession 12 months later. That recession did not come about. The US economy was in relatively good shape. Like what I would call the key pillars of the US economy are operating in good shape. And I mean, corporate balance sheets are relatively healthy. State and local governments are operating in generally good credit place. and bank balance sheets, at least the largest banks, appear to have enough capital. The consumer is in good shape, but I think it's really important to delineate that inflation has been challenging to many quintiles of like the consumer population. And the part that's really done the best have been ones that have had access to capital markets or substantial amounts of capital market savings. So it's not equal. Clearly, it's not equally distributed, the benefits of this. That allows the US economy to stay, I think, in a positive growth setting. It doesn't mean you can't have outside problems that can creep in. We're starting to see some cracks in what's called the private credit space, which is the market where it's not like publicly available. You can't go buy the bonds, etc. These are like private loans made by firms or non-bank lenders to sort of small and mid-sized corporations. We're certainly seeing, what I would call some cracks there, and that could slow things down over the course of this next year. But from a fundamental starting point, the broader economy is in good shape, so it can take what I'd call a little punishment. So from an investment perspective, we're still relatively positive on things that will benefit from continued growth in the US economy. Parts of the credit market being very selective, obviously, about that. We think as rates get cut, treasuries should benefit. Even longer term treasuries, where the rates are substantially higher right now, could be a place where there's likely to be a benefit. State and local governments are in good shape. And as rates come down, there's an excellent chance that they'll even be able to access even better financing. So I think those parts of the credit market we're broadly positive on. And we think, as we think about allocation, we have that top of mind.
Amar, great stuff. I really appreciate it. I have more questions, but as often happens here on the show, I am out of time. But we'll do this again at some point in 2026. Thanks so much for joining me today.
Thanks a lot, Chuck.
That's Amar Reganti, fixed income strategist at the Hartford Funds. You can go to hartfordfunds.com for more information on him, the firm, and what they do. And what we do here, where we talk money. But up next, we're going to the baddest biker bar in the investment world. We are heading for the danger zone with David Traynor of New Constructs when Money Life returns in just a moment. If you're looking for trouble, you've come to the right place. Belly up to the bar at the baddest biker bar in the investment world. This is the Danger Zone. Welcome to the Danger Zone on Money Life. It's where we get the latest take from the experts at New Constructs, where they evaluate securities on a scale of most attractive to most dangerous. They do it by bringing together discounted cash flow analysis and forensic accounting. They dig in at the footnotes level, work their way up, and they frequently find that what you see when you just do the skin-deep, top-down look is misleading. And if it's misleading and it worked in your favor, that would make something attractive. But what we typically focus on here, the ones where it's misleading and it could work against you, which would make something dangerous. Learn more about how it works by going to newconstructs.com. David Traynor is founder and president at New Constructs. David, great to chat with you again.
It is great to be with you, Chuck. Thank you.
Who's in the danger zone this week?
DoorDash.
Danger, danger.
DoorDash. It is ticker symbol Dash. We are in the baddest biker bar in the investment world, but we had to order out to get something this ugly, although it's been in the danger zone before. And the real danger here is that third quarter stock gains were so good that somebody might think this is a tasty morsel again, isn't it?
Yeah, that's it, Chuck. This has had a great run here recently. We've seen a big junk stock run, I think, in general. DoorDash is a really broken business model. It's funny they do all these announcements about how they're going to do delivery for these firms. They're not getting paid for those deliveries. They're just getting volume, and the underlying business is marginally profitable at best. And the cash flows are still quite negative. And we just think like this thing is still grossly overvalued.
Stocks can defy gravity for a while. Let's point out, this has been a stock that first went into the danger zone prior to its IPO. So you have never liked this from the moment people had the chance to buy it. It has been a zombie stock, but it became a zombie stock in 2022. And anybody who knows, if they listen to the danger zone regularly, a zombie stock is a company that is basically the Walking Dead because it's burning through all its cash. But to be a zombie stock, you're supposed to have less than 24 months of cash. So here we are talking about this thing. It's had this revival on the stock price. It's survived its zombie stock stuff because it's still here and it was a zombie stock for more than 2 years. So what's happened to allow this to keep going to get to where it is now?
Oh, man, they sell stock, to fill the gap. People are still, buying into this baby. That's what's keeping them afloat. I think the biggest red flag here as of late is management kind of got cocky, like, hey, we're actually making a little money. They did have a positive operating profit after tax, positive NOPAT, positive return on invested capital. Surprised us. And management got cocky and started talking about big spending plans and sent the stock down more in one day than it's ever been. And it's like, hey, guys, you need to listen. You need to stay in your lane. You're not that good at business. The stock price implies that their marketplace gross order volume is going to be way bigger than where Uber is. Way bigger, like multiples bigger. So we're just seeing a valuation that is entirely disconnected from reality in terms of expectations for future profits and growth.
You talked about management getting cocky, and then the stock fell almost 20% in a single day right after it came out with earnings. And because, again, the earnings were positive. In your experience, does the market's response to this ever beat bad ideas out of management? Like, it's not you saying, hey, we think this is a bad idea. We think you're valued improperly and whatever else. It's the entire market basically going 20% in a day or nearly 20% in a day is a pretty bad sign. Does that ever, market ever beat you into understanding the truth? Like, is there any thought that the market will somehow make them wake up?
It depends on the environment. Remember a few years ago when Uber was getting beat up and they said, oh, we're no longer going to use adjusted EBITDA as a key metric. And that business, has since leveled off at a fairly decent amount of profitability. Now it's still super expensive. And that was a tough environment. That was like a post-COVID, like market correction time. In this environment, I don't know. Another big stat here for you is that the current stock price implies that DoorDash is going to generate something like $15.5 billion in net operating profit after tax in 2034. Within 10 years, they're going to get to that level of profit. FedEx, UPS, and Uber combined did $17 billion in profit in the trailing 12 months. So this is expecting some dramatic growth for DoorDash that we think is just entirely unrealistic.
What is a more realistic value? If this were priced for reality, what would it be priced at?
Well, we ran a scenario putting the stock at $73 a share. Let me tell you what the current stock price implies as context. So to justify $187 a share, the company's got to improve their margins from 5% to 9% and grow revenue 32% compounded annually versus consensus of 8% through 2034. That's what $187 implies. If we want to drop to 73, they get their margin up to 8%, which is the average of UPS, FedEx, and Uber. They grow revenue at consensus estimates over the next few years, and then by 19% through 2034 as opposed to 32%. And that gets you $73 a share. So even that's, I think, pretty aggressive. So I'm guessing you're going to want to know what the economic book value of this business is, Chuck, because that's, I think, a good baseline here to get a sense of what do you have right now? Like what kind of money, cash flows in the bank out of $187, $10. That's the economic book value. $10 a share is what they got right now. So you got effectively $177 out of 187 is all predicated on future profit growth. That's I think that kind of paints the picture well.
Obviously, DoorDash has plenty of competitors. Is there any stupid money risk here? Is this a business that somebody else would want? Or given that the economic book value is like $10 a share on a stock that's trading in the 180 range, they can wait until this thing, pretty much craters out and buy the assets if they want to do that.
Yeah, that's right, Chuck. The hard thing about stupid is it's hard to predict, right? Stupid is so I don't have a good answer on that. I mean, there's always stupid money risk, and the stupider it is, it could do whatever it might do. But it would be really stupid to buy at this price because I think you're going to see this thing come down a bit. And if you really want or are interested in a delivery business like this, then you got plenty of time on your hands because I know Dash is out there making deals to do deliveries without imposing any expense, I think, on the vendors, just charging the clients looking for volume. So I don't know if there's a reason to buy at this point.
Well, and in fact, if you wanted to define stupid money risk, what the market was saying when it pounded Dash after the last earnings report, et cetera, was, hey, you guys are saying you're going to go out and make acquisitions. So they were saying Dash was the stupid money, was they were spending it on other things. So maybe stupid is as stupid does, and that's why DoorDash, ticker symbol Dash, is back in the danger zone. David, great stuff as always. Enjoy the holidays. We'll see you again soon.
Thank you very much, Chuck.
David Traynor is founder and president at New Constructs. Go to newconstructs.com to get more information, see the most dangerous, most attractive stocks list, and much more. And speaking of much more, we've got much more to go on today's show. Up next, we're talking with Martin LeClaire from Barrack Yard Advisors. It's the market call, and it'll be here when we come back in a flash.
Oh, wow. This is actually pretty dangerous.
Looking to earn CE credits and hear from top portfolio managers? Go to etftrends.com/webcasts and learn more.
Martin LeClaire, Chief Investment Officer and Portfolio Manager at Barrack Yard Advisors, is here. We're talking show me the cash investing, and it's time for the Money Life Market Call. Welcome to the Market Call, the part of the show where we talk with experienced money managers about how they do their job, what they look for that determines their buys and sells, what they see happening broadly on the market, and how they put it all together. And returning to the Market Call today, one of your favorites, I know because you tell me about it every time he's on the show, Martin LeClaire. He's Portfolio Manager and Chief Investment Officer at Barrack Yard Advisors. And if you hear him and you want to learn more, well, barrackyard.com. Martin LeClaire, it's great to have you back on Money Life.
Thanks, Chuck. It's great to be back. Always good fun.
I described it as show me the cash investing because an essential part of what you do is making sure that you've got a company that's showing you the cash. But help us understand exactly what it is that you're looking for that goes in and makes you say, this one is showing me enough cash to make it worth buying, and that one, not so much.
Well, fair enough. And thanks for ruining my my intro. But that, our mantra is to concentrate on investment basics, and it's the Jerry Maguire movie. Show me the cash. I mean, all investments ultimately have a cash yield. If you own a stock that doesn't pay a dividend, it's still, if it's a profitable company, would have a cash yield. They just keep it either to pay down debt or reinvest in the business, or that sort of thing, or to just keep their powder dry. One of the things we look at is really the source of investment returns. And on the individual basis, the first place is to look really at what we call the real yield, which is, accounting has all kinds of rules behind it. But ultimately, our definition of cash is really what's left over in terms of the money that you can take to the bank if you're the company. And we look at that amount and whether it's sustainable, what's the likelihood of it to grow into the future. And we just then simply divide that into the current market price of the company. And that gives us what we call our cash yield. It's pretty simple. On a bigger basis, we also, in terms of source of investment returns, is we'll look at indexes. For example, right now, one thing that's an historical outlier is the fact that so few companies in the S&P 500 are driving all the returns. And so that's of great interest to us, and it has implications that are profound. For example, we believe because of the source of the investment returns of the S&P 500, that our base case is that the S&P 500 index in 10 years from now will be no higher than it is today in real terms.
Well, that's alarming, but that's why you're looking for yields. Help people understand, is there a specific level that is like, this is my cutoff, I do not go for it if there's not a certain level of yield? And how dynamic would that floor be?
Prior to the growth of growth investing, which was a concept in the 1920s, that took off. And then after the Great Depression, or during the Great Depression, value investing came into vogue. But prior to, and then momentum investing has always been with us, at least for the last 300 or 400 years. But there used to be, prior to the 1920s, the idea that, rich people should own bonds. But if you can own a stock and it yields 5%, and that business looks like it has legs in terms of meeting a human need and can do that for a long time, then buying a stock at a 5% yield seemed to make sense. And so for blue chip companies, our bottom would be like a 5%. So if Coca-Cola had a free cash flow yield of 5%, which it doesn't, it's below that right now. But if it did, then that would be of interest to us. In terms of more speculative businesses, for example, Dine Equity is a holding company that owns the franchise rights to IHOP and Applebee's, for example. Their free cash flow yield is 25%. So in theory, they could buy back the whole company over the next 4 years. So that's of great interest to us. We think that's it could be a value trap, but we think, we're getting compensated for it. So basically in our portfolio, it ranges in terms of free cash flow yields on the low side, 5, 6, 7%. On the high side, most of them are in the low teens, but we have a couple of outliers which are higher.
You talked about how you do not expect the S&P to necessarily be higher a decade from now. You have a process. We've talked for years. You have a process. That process has not changed, but markets do change. So if you're expecting a long period of down or sideways or just lackluster, does that force you to change anything in the process?
Not really. I mean, the other thing, apart from focusing on investing basics, which heavy component is looking where the cash is, the second thing is we're students of history. And we believe that markets are mostly driven. Certainly, Professor Schiller at Yale has shown that in any given year, 90% of the move in the stock market is attributable to shifting investor sentiment and has nothing to do with changing fundamentals. And so, because financial markets always have been and always will be driven by sentiment, and we also don't believe history is linear, we believe history is cyclical because human nature doesn't change. And so, based upon that, our view is that just the names are different, but we've seen this show before. And in history, in terms of the equities market, we have 400 years of data that we look at. And in terms of the debt market, we can go back 4,000 years. We have ways of understanding how the debt market worked even as far back as the ancient Mesopotamians.
But how relevant is that ancient history to right now? Like, because it's hard enough for people to say with what we're going through that stuff that was occurring in the 1970s or the 1990s is an apples to apples comparison. How much and how often do you go back to ancient history, even if it's just to try to boost your confidence that, hey, we invest this way over all conditions?
Well, there seems to be, and again, the names change, but there seems to be in history this 50-year debt cycle that goes back forever. And basically, it's just the idea that societies build up debt and then they get to a point where there's too much debt. And then there's the downside of having to deal with too much debt. And if we look at where we are over the last 40 or 50 years, when Jimmy Carter left office, debt as a percentage of national income was about 33%. Now it's over 120%. And so we've had this huge buildup in the long-term credit cycle. Ray Dalio has some wonderful videos that people can Google, which talk about the long-term debt cycle versus the short-term debt cycle. And one of our major theories right now, or our thesis, is that all the tailwinds we've had over the last 40 years or so, which is ever lower interest rates, ever higher levels of debt, ever higher valuations in terms of security prices, the whole movement towards financialization of everything, that's a trend that will be a headwind in the generation to come. Now, in the short term, none of that really matters, but it does give you an opportunity to frame things. And I guess the other thing I would say is that we love paradoxes, and I don't think your listeners maybe appreciate investment paradoxes as much as they probably should. For example, most people are long-term investors. Unless you plan on outliving your money, by definition, you're a long-term investor. Yet most people are concerned about what their portfolio is going to do over the next 3 to 6 months. But I tell you, in 30 years from now, what happens over the next 3 to 6 months or 2 years is fairly irrelevant if you're investing in businesses that you plan on holding for the next 20 or 30 years.
So you mentioned Dine Brands, but is there another poster child, if you will, for the methodology, something that really stands out to you right now?
Well, right now, in terms of like recent purchases, I have kind of two buckets. One are areas of the market, blue chip stocks that are, and Dine Equity, by the way, is one of the more speculative names we have, just for the record, is what I call the 5%ers, paying 5% dividends on quality blue chip businesses that have growth attributes which are out of favor on Wall Street and which actually have dividend yields of 5% and the cash flow more than adequately covers that dividend yield. So examples of that would be Kimberly-Clark, for example, or Clorox, or T. Rowe Price, or Verizon. So I would call those the 5%ers. And then the other bucket that we have is what I would call the nonlinear sort of third level thinking regarding the artificial intelligence opportunity. The artificial intelligence opportunity is for real. But one thing we do know from history is that in the short term, like 2 or 3 years or so, investors overestimate the short term, intermediate term potential exponentially. But in the intermediate term, they then underestimate this revolution that goes on. So the AI thing is for real, but in order for the AI thing to be real, you need massive data centers. And they're talking about building 10 gigawatt data centers. Now, most people are going to zone out right now, but let me just say 10 gigawatt data center. This is one data center. That equates to roughly 7 to 8% of the current daily consumption of oil in this country. So you're going to need enormous amounts of energy to build these data centers. These data centers, no one wants to live near. The old-fashioned ones, which are in Northern Virginia, no one wants to be near them, are like child's play compared to the new ones that are being built and going to be built. So you don't want to build them where people are, and you want to build them where the energy is really cheap. And to us, that means you got to look at the Permian Basin out in West Texas as a 10 to 20 to 30-year play. And to us, the best way to play it is through the businesses that own lots of land out there with cheap energy. In the Permian Basin, the price of natural gas is negative. You have to pay to get rid of it. So all they have to do is build these big data centers. The hyperscale is going to be building data centers out there, and three companies we own will benefit from that. One is Texas Pacific Land, which I've spoken about many times over the years. And another one, a fairly new name in our portfolio, is LandBridge, which is a more modern uptake on the TPL. And these are royalty models. And then the third name is WaterBridge, which is the largest water infrastructure company in the United States that's publicly traded. They will be providing the data centers with the water which is needed for cooling.
Well, now we're going to get your quick and dirty take on some stocks that my audience is particularly interested in.
Quick and dirty.
Well, I think we're having fun now, eh, folks?
We are having fun now, and we're having that fun with Martin LeClaire. He is Chief Investment Officer and Portfolio Manager at Barrack Yard Advisors, which you can learn about online at barrackyard.com. You know how quick and dirty works, so we're just going to jump straight in, starting today with the biggest name that's on the list. Michael in Fairfield, Connecticut wants to know about Microsoft, which, by the way, is in my portfolio. It's MSFT.
Microsoft's one of the great businesses of the world, and there is nothing you can criticize about it in terms of its performance. The stock has performed much better than its earnings over the past 10 years, and much better. It has grown much faster than its free cash flow. So Microsoft is trading on a free cash flow yield of 2%. Historically, it's very, very expensive. And by our calculations, fair value would be somewhere in the 200s. The issue is really this. I think the metaphor I want to use may not be a perfect metaphor, but Microsoft and the other big internet companies that prospered, 25 years ago, they've been able to, until recently, build their business. It's almost like, think of a trucking company. They were like a trucking company that was able to use free roads that were built by others. But now imagine what that would do to the business model of a trucking company if they had to pay for the roads from scratch. And that's what's happening with big tech right now, is that for the first time, and Wall Street doesn't have any experience in a bubble in which capital investment was required, such as, the railroad bubble and the canal bubble and so forth. So story short, great business, great company, but their free cash flow is going to be used to build these hyper centers, these AI centers. And who the heck knows what kind of rate of return they're going to get on those huge capital outlays. So I wouldn't own Microsoft at this level.
It's topped out. I say we sell now.
Yeah, it's great company, not necessarily a great stock. Certainly at this level, that's a sell on MSFT, Microsoft. Our next request comes from Dale in London, Ohio, wants to know about Associated Capital Group. That's ACGP.
Associated is a good business. It's part of the Gabelli holding company that owns a lot of the Gabelli businesses. Mario Gabelli, to me, is one of the great investors of all time, and plus a lovely guy. He actually called me a couple of years ago out of the blue. And the stock's trading at 12% to its discount to its book value. So you're buying it below, and half of the market cap is in cash. And so it's, I prefer T. Rowe Price because they have much bigger scale. And the asset management business right now, believe it or not, is not great unless you're just a creator of indexes. So I'd rather own T. Rowe Price, but I can't fault owning Associated.
Basically, that means hold it if you've got it.
No money changes hands today.
But if you're looking for something to buy, while Associated Capital Group, ACGP, could be a buy, Martin LeClair's preferred buy in that space is T. Rowe Price. Ray in Buena Vista, Florida gets our next request. It's for Primo Brands Corp. That's PRMB.
Yeah, so it's kind of like a crummy business. They have, low return on equity, very low return on invested capital. More importantly, very low quality. That hasn't really grown much. They did this merger. The big players in this industry, the water business, have gotten out of it because it's kind of a crummy business. On a free cash flow business and earnings, they're basically at break even. And, it could be a good spec, except that it's so highly leveraged. You have its current market cap is equal to the debt outstanding. So I would not own this company.
So yeah, you'd love to make a splash with a water company. But Primo Brands, PRMB?
Oh boy, that sounded bad.
Sure did. DA in Honolulu wants to know about Lending Tree. It's ticker symbol TREE, TREE.
Well, everyone knows the name. They have a great brand name, I think, but it's a very speculative stock. Over the last 10 years, the book value has dropped by 2/3. And with these financial companies, book value really is the key metric over the long term. So their book value has gone the wrong way. Over the last 10 years, the debt has gone up, as well as the number of shares outstanding. So, they've been really excellent at destroying shareholder value. Stocks like 48 or something, and the book value is like $8. So in a bear market, if Associated Capital is selling at a discount to book value, I think this should be selling at a discount to book value as well.
Time to sell the dream.
Yep, time to sell the dream. That's a sell on TREE, Lending Tree. And last, for Scott on Whidbey Island in Washington, it's Union Pacific Corp, UNP.
So Union Pacific is just really quality business. Historically and consistently, their return on invested capital has been in the low teens. They've been able to use their ample free cash to pay out a competitive dividend and shrink their shares. So they have been growing, and they probably can continue to grow at between 8 and 10% a year. The dividend's 2.5%. That will grow every year, most likely. I think UNP, even without the potential merger of Norfolk Southern, is a good investment. I recently bought some as an initial position. If it goes lower, I plan to add to it over time. So, and the NSC thing, the National Norfolk Southern merger, if it goes through, will create the first transcontinental railroad where they go from, so that should really put them in a sort of a class of their own. So I would say if you have a long-term perspective, UNP is definitely a buy.
So we finish on a high note. UNP, Union Pacific Corp.
Either gets on board or he gets left behind.
Yeah, you either get on board, buy it, or you're left behind. And unfortunately, we've come to the point in our show where we have to leave Martin LeClaire behind. But Marty, it's always great to catch up with you. Thanks so much for taking the time.
Thanks, Chuck. It was great. Appreciate it.
Martin LeClaire is Chief Investment Officer, Portfolio Manager at Barrick Yard Advisors. BarrickYard.com is where you go for more information. And if you want to know if he was agreeing or disagreeing with some recent guests, well, stick around because we'll come back and we'll tell you that. We'll set you up for the rest of the week, including an amazing show that we're going to have for you tomorrow. But we'll let you know our plans for Black Friday and more. And then we'll wrap things up right after this message.
Everything an advisor needs in one newsletter. Go to advisorperspectives.com and see why 100,000 advisors are subscribed to our newsletter.
We are back to wrap this one up. A lot to do and not so much time. I want to point out that Martin LeClaire talked about Coca-Cola, of which I'm a shareholder. He talked about Microsoft, of which I'm a shareholder. Remember, I'm not allowed to make any new moves in securities we discuss for 15 trading days after they're talked about on the show. Not that I was planning on it. Oh, by the way, he also talked about Verizon, which I also own. So I'm not allowed to make moves in those things if I was going to. Coca-Cola is not his poster child. He said that the yield is not high enough to buy it. It was the first stock he talked about. Jay Hatfield from Infrastructure Capital Advisors was selling it back on August the 29th. Then you had KMB, Kimberly Clark. It was one of his poster children because he basically put his 5%ers in there. And Mark Dixon from Horizon Investments was selling it back on November the 13th. Then you had Verizon. It was a buy today. Nitin Sacheti from Papyrus Capital was selling or avoiding back on October the 14th because he said he would give up on the mobiles in favor of the cable companies. James Abate from the Center Funds was buying back on July the 23rd. After he finished with his 5%ers, his poster children, he talked about Texas Pacific Land. Stephen Gray from Gray Value Management was speculative buy, maybe wait for a better price back on October the 17th. During Quick and Dirty, you had Microsoft, MSFT, labeled as a great company but a bad stock. Seth Cogswell from Running Oak Efficient Growth was trimming it. It wasn't a full-on sell, but he had valuation concerns. Hank Smith of Haverford Trust was buying it back on July the 15th. Ed Schill from the Wealth Enhancement Group, QCI team, had it as a hold, but had stops in place on it back on June the 23rd. Tomorrow on this show, oh my goodness, my guests are Marta Norton. She's Chief Investment Strategist at Empower. I'm super excited that she's making her debut on the show. Also debuting on the show, Dom Rizzo, Portfolio Manager for the T. Rowe Price Technology ETF. He's doing the market call. And then we're talking technicals with Julius de Kempenaer, Senior Technical Analyst at Stock Charts. That is a fabulous lineup. But we've got other great things coming all week. So yes, it's a holiday week, but stick with us. Meanwhile, today is Celebrate Your Unique Talent Day. It's D.B. Cooper Day. Yes, in 1971, on a one-way ticket from Portland to Seattle, a man who identified himself as Dan Cooper ordered a bourbon and a 7-Up and gave a note to a flight attendant that said, "I got a bomb in my briefcase. I will use it if necessary. You're being hijacked." He got away, and of course, people have been looking for him ever since, although they basically closed the case in 2016 and said they were stopping to the investigations. It is also National Use Even If the Seal is Broken Day. Although, if it smells bad...
Yuck, what reeks?
Well, maybe you don't want to use it if the seal is broken, even though it might be sardines, because they do smell bad. It's National Sardines Day. It's also National Carmenere Day. It's a type of grape akin to a Merlot or a Cabernet, found mostly in Chilean wines. My guests today were Rachel Perez, spokesperson for North Star Inbound. The study we talked about was for bestmoney.com. Amar Reganti, he's fixed income strategist at the Hartford Funds, online at hartfordfunds.com. David Traynor, of course, is from newconstructs.com. And Martin LeClaire is for the Chief Investment Officer and Portfolio Manager for Barrick Yard Advisors, barrickyard.com. Thanks to them. Thanks to Rob Floyd, my producer. Thanks to Maho, my dog.
That was easy.
Yeah, we were teaching him to hit the easy button to get treats, and he was figuring it out. We may put that up on Instagram for you. But mostly thanks to you for being here, because you make this special and worthwhile for me each and every day. The Money Life quote of the day comes from Amy Grant, and this week we'll do most of our quotes about Thanksgiving. She said, Thanksgiving Day is a good day to recommit our energies to giving thanks and just giving. Giving is a sign of money maturity. We hope you will keep that in mind as you're doing it, because it helps you keep money in perspective. So too is remembering what I tell you every day, which is, until we do this again the next time, best thing you could do for your money is not worry too much about it. Have a great day, everybody. Stay safe and calm. We'll see you here on Money Life tomorrow.
The people who appear on Money Life are here for your and their own entertainment. Don't take advice from us or any other podcast without doing more research and/or consulting your financial advisor. We believe our guests provide reliable information, but we can't and don't guarantee the accuracy or completeness of their statements. Opinions expressed on Money Life are those of the host and guests only and reflect their personal thinking. They're not representative policy or strategy of any employers or sponsors. This show is produced by Money Life Radio, which retains all rights to the content. If you want to use any part of this show for your own purposes, be they good or evil, you must get our written permission first. And remember, with great financial information comes great responsibility. Please act responsibly.
And like that,